Hey everybody, it's Larry Berman here. Happy long weekend. I can't believe I'm doing one of these on a long weekend. I can't imagine anybody's watching. Everybody's out enjoying the last few days of summer here. I remember as a kid going to the CNE, watching the air show. Actually worked at the CNE one summer when I think I was 18 or 19. Anyways, great memories. So for me, I'll be golfing on the weekend, but it's a 24/7 job for me, and I'm always thinking about markets and what's moving and looking for new ideas. So let's have a look at the chart room and see what we learned this week. We don't normally focus on Canada, but there was a big surprise in the quarterly GDP numbers that we saw to Canada. Expectation was for in Q2 was for a gain. Bank of Canada's target, I think, was 1.5. The survey on the street was 1.2. And while the monthly number for June came in at 0.2, there was a significant revision to Q1 and also to the previous month, taking the total number for Q2 down to a negative. So Canadian economy at the moment has one toe dipped into the hard landing scenario, and that has meaningful impact for lots of things in Canada. Most immediate impact hits the Canadian dollar. We had seen earlier in the week on some better than expected inflation numbers that the Canadian dollar that spiked up towards 136.50, which was in line with the previous two highs that we have seen in the Canadian dollar. Now, we hit those highs when this purple line, which is the inverse price of oil. So oil below 70 in here, oil above 80, 85 in here, where we are now. So it's the inverse. And we have it on the chart as the inverse because it influences the currency. Weaker oil prices, higher CAD rate, meaning lower Canadian dollar versus the US. The other element that we look at is this green line, and that is the interest rate differential between two-year treasuries and two-year Canadas. So this week, we saw oil prices surge, and we saw the rate differential between Canada and the US weaken, specifically on Friday after the employment report. So expectations for the Bank of Canada almost completely off the table. After the employment report, it's largely thought that the Fed is done raising rates. Maybe there's one more. They're still going to talk about the possibility of one more, we believe, but in practicality, they are both likely done raising interest rates. With China and Europe also struggling to grow, you've got an increasing part of the world kind of weakening. In the US is now sort of the strongest economy in the world at the moment. Obviously, China is going to grow a little more. India is going to grow a little more, but as the largest economy makes sense. So it's slowing. Manufacturing is basically in a recession, but for the most part, markets are markets are not pricing in the reality of a hard landing. It's pure soft landing, and we've been talking about this for quite a while now. So what hasn't changed this week? The fact that bond supply is going to remain ample and plentiful in the months and quarters to come. So we got a little bit of a relief rally where we saw long bonds rally. Recall a few weeks ago we were telling everyone we were nibbling in here. We trimmed this week here and here, and again we'll look to buy back into that next dip. I suspect it keeps going lower lows, lower highs, lower lows, lower highs, and it starts trending towards higher yields as the supply dwarfs. Now, China, on the currency weakness side, is going to be forced to sell treasuries to support their currency. So there's a lot of that natural buyer historically that's going to back away. We will see significant duration buying when the hard landing scenario starts to play out. And when that does really start to play out, folks, you want very little to do with the S&P 500 at 4,500. That's for darn sure. When we look at the Treasury supply calendar, the dates we need to be concerned with is the week of September 11th, where we get the 3-year, 10-year, and 30-year supply. That is going to be the big inflection point in September. September 15th is our triple or quad witch on the quarter. So that should be an interesting week. As we know, historically, September is a bad month for the year, worst of the year. So follow on to a little bit of August weakness. We think the markets will come off at least retest the September lows at some point in the next few weeks. But for the most part, we've priced out most of the rate hike hopes for this year. But again, scrolling into the end of 2024 and into early 25, almost 5 rate cuts priced into the market. And we just don't think that's coming in a higher for longer scenario until the economy breaks. I can't reiterate that point enough week after week after week. So don't get lulled into the fear of missing out and the soft landing scenario. The odds of a hard landing are increasing by the day. So let's have a look at the Qs, because the NASDAQ has been the leadership all year. And again, up towards the highs. Remember, we had this failed new high. We heard about all the coupon supply coming in here. Markets sold off as yields rose. We've bounced, at least today, on the better than expected employment number. We saw a little selling. So we'll see if there's follow through. Maybe it was just illiquidity around a holiday weekend. TBD next week. But as we get into the bond supply the week after, we should expect to see a retest of the lows, unless that supply is taken down with very, very strong demand. So TBD on that one. Let's have a look at a couple stocks, one we hate and one we really like. Now, I drive a Tesla, but as I said for a long period of time, this is not a tech company. Yes, it was a growth story. There's no doubt about that. But Tesla cut its prices yet again and has now brought the Model X discount on a year-to-date basis down massive, so that they could now qualify for a tax cut. Model X at the beginning of the year was $120,000. So what is that going to do for margin? Well, last earnings call, Elon Musk said, don't care about the margin. We want the volume. Guys, this is a car company that should be trading at a mid-single, maybe high single-digit multiple at best. Yes, they do a lot of other things, and batteries are big, and so that's why they'll get a premium to Ford and GM and Stellantis that are going to go into this UAW strike likely in the next. I mean, what they're asking for in wage demands is not surprising given what we saw at UPS and some other settlements. A 32-hour work week, 40% raise over the contract life. That's going to significantly put some cost pressures into the auto industry without a doubt. So if Tesla should trade at 20 times earnings and it's trading at 72, earnings are going to come down because of margin pressures. So the PE is going to go up. You factor all that in, and this stock should be trading below $100. So I know the bulls on Tesla don't like to hear that. I get it very much. I drive a Tesla, a little pissed at the price cut because I probably paid, looking back a year ago, more than I should have, even though I bought it at a wholesaler. So here's something I like a lot. Walgreens. So drugstore chain moving into the healthcare space. I think these guys like CVS are very well positioned as population ages. They need more localized services. There's not enough doctors to service everyone. Basic medical care, needles and flu shots and things like that will be done at the pharmacy in the future. You won't have to go to your doctor. They'll have doctors and pharmacists in all the locations, or many of them, and that's a new business line, and I think a huge growth potential. They're having some problems here. The CEO was let go, mutually beneficial apparently, and so this stock is now trading back at the levels not seen since the great financial crisis. And so we think there's tremendous value. Yeah, there could be a dividend cut here. It's currently yielding over 8%. I wouldn't buy it for that reason, but I love the value here. For me, a 3% position is my maximum. I've been running this now. I've been accumulating this stock below 30 in recent weeks. I'm now up to 1.5%. I just wrote puts today on Friday to buy another whack in January at $20. I took on a nice 3%, 3.5% yield to do that at the close on Friday. And this is a nice value play. So there's always something to buy. There's always a place to look at for a bull pick. Here's one of them. It's a value play. Might be tough for a little while longer, but I think there's a double potential here over the next couple of years compared to a Tesla, where at best the stock gets cut in half where we are today. Have a great weekend, everybody, and enjoy the rest of the summer.